Silver for the last 10 years, there's been a deficit of production and we've been drawing down above ground supplies. No one's making that parallel with gold yet until Citibank. So what Citibank is essentially saying is that mining production is a shortfall, and we see it being a shortfall for the next 3 years at least. It seems that way. There's not enough production to satisfy physical demand, whether it's industrial or monetary, I don't care. 6,000, walk through what it is, what it takes to get there. It should be noted that Citibank's baseline, which they say they have low confidence in, their baseline is that gold's going to be flat for the year of 2026. Okay. Their upside is if this structural deficit of production remains the same, then and physical and people, the world keeps stacking, we're in trouble. It'll go to 6,000.
In this powerful market breakdown, metals analyst Vince Lanci highlights a critical trend unfolding in the precious metals sector, one that major institutions are only now beginning to acknowledge. For the past decade, silver has faced a consistent production deficit, forcing the market to draw down above-ground supplies year after year. While many analysts have ignored similar risks in gold, recent attention from Citibank indicates that the same structural imbalance is now forming in the gold market as well. According to the analysis, global mining output is simply not keeping pace with physical demand, whether industrial, monetary, or investment-driven. Citibank's outlook suggests that this shortfall will persist for at least the next 3 years. Their baseline projection shows gold remaining flat through 2026, but even they admit confidence in that forecast is low. The real concern lies in the upside scenario. If production deficits continue and worldwide accumulation accelerates, the system faces severe pressure. Under those conditions, Citibank warns that gold could violently reprice, with targets reaching as high as $6,000 per ounce. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
If gold divided by the S&P 500 settles over 60%, you have this big rounding bottom that will be complete, like a saucer bottom. And that would also coincide with a momentum breakout, not just a chart breakout for him. And momentum is a big thing for him. And when you see that chart hit gold versus stocks, then you go to the silver chart, gold versus silver, and you say, well, how does silver look relative to gold in terms of performance if this is true? And you look to see if it's going to lag or lead. And he's saying that it will lead. And his contention is that people will say that silver goes down with stocks. And you've heard me say that a million times, okay? And he's saying that that's not going to hold this time. So you will hear me say that silver will be slammed along with stocks because it's an economic metal, because it's an industrial metal, because of its industrial aspects. And I want you to know that's a tactical thing that I say to see how the market's behaving. It's when silver doesn't go down after stocks get slammed that I raise my eyebrow, because that's a sign of yet another correlation breaking. See, all the things that I focus on are correlations and when they break. So the dollar gold correlation, which broke 3 years ago, we told you the dollar gold correlation is breaking. No one is selling gold when the dollar strengthens anymore. Rates are going up. No one is selling gold and rates are going up. And now we're at the cusp. This is where I agree with Michael almost everything here. We're at the cusp of silver ignoring stocks. And so it goes from an industrial metal with monetary qualities to a monetary metal with an industrial kicker. And I wholeheartedly agree with this stuff that Michael's talking about, or I would not be spending so much time talking about it with you. Stay with us. We'll go through the charts at the end. Related post, Founders Milkshake versus Gold Bug, the coming U.S.-China clash. That was a Founders post, and it is about the fact that we think it's going to be a China bond with gold implied versus a U.S. bond with stable coins implied as your collateral going forward. And we go into how it should play out in terms of tactics and who's going to do what, but we don't predict the outcome. We just predict who's going to do it. It's a behavioral analysis. 6,000, walk through what it is, what it takes to get there. It should be noted that Citibank's baseline, which they say they have low confidence in, their baseline is that gold's going to be flat for the year of 2026. Okay. Their upside is if this structural deficit of production uh, remains the same, then and physical and people, the world keeps stacking, we're in trouble. It'll go to 6,000. And then Hartnett, Santa Claus, that's equity. Catherine Austin Fitts on the stablecoin control grid. We appreciate that because we think she's an excellent plumber. A little bit depressing if you're an Orwellian person. Status of the U.S. dollar as global reserve. That's a slide deck that breaks down the qualities that make gold. It's also be gold Freudian, that make dollar the global reserve currency. It's in everyone's hand. It's got a great network, Swift, and the reason that's very helpful if you're a watcher of these things. It's one thing to say the dollar is going to zero. It's another to say if this breaks, it's like a checklist of things that have to break for the dollar to lose global reserve status. And so we think it's very important. Goldfix PM, bad day for gold, worse week for banks moving forward.
In this powerful market breakdown, Vince Lanci explores a major shift taking place in the relationship between precious metals, equities, and global financial indicators. According to the discussion, the gold to S&P 500 ratio is approaching a critical level. If this ratio breaks and settles above 60%, it would complete a massive multi-year rounding bottom, signaling a historic momentum breakout. This shift wouldn't just be a chart pattern. It would mark a deeper change in how capital flows between risk assets and safe haven metals. From there, attention turns to silver. Traditionally, silver tends to fall alongside equities due to its industrial exposure, but signs are emerging that this correlation may be on the verge of breaking. Analysts describe a scenario where silver begins behaving more like a monetary metal, refusing to drop even when stocks sell off. When that moment comes, it becomes a powerful tell that the market structure has fundamentally changed. This narrative aligns with broader global trends: broken correlations, rising gold despite higher rates, and institutional forecasts warning of potential price surges if structural deficits persist. Citibank's upside case even projects gold reaching $6,000 under continued supply stress and aggressive global accumulation. These signals suggest a major realignment across global markets. Let's get into the interview.
10-year yields are unchanged offered. The dollar is up 17. The S&P 500 is down 17. NASDAQ is down 101. The VIX is up 1. Gold is up 50 cents. Silver is up 37, 35, 37, off its highs, but still strong. A bit stronger all night. Copper is down 2.5 cents. WTI is up 31. Natural gas is 426. Up a penny. Bitcoin up 580. Skating around on its lows. I don't like that chart right now. Who does, right? Ethereum, Palladium, volatile, up 1, down 5, depending on if you blink or not. Platinum up 7 and change. Gold, silver down again in the 80 area. That's a very important chart we'll be talking about with the Michael Oliver report in mind. And grains are all up 1%, 37 basis points, 99 basis points. Soy, corn, wheat. Okay. Let's get to the main show here. All right, so Mike Oliver's structural work shows gold and silver entering a major secular turn. Gold is breaking out against the S&P, signaling a shift in allocation away from equities. Silver is positioned for an even larger move once its momentum ceiling clears. So this is the beginning of, paraphrasing him, a generational rotation into metals. And who are we to disagree? Briefly, Jordan Roy Byrne and I have been covering gold versus the 60-40, and that broke out, 60-40 portfolio, and that broke out about 6 months ago. And then silver versus 60-40, and that broke out. And then he was covering miners versus 60-40 and things that I don't normally look at, but he was saying pretty much all systems are go. So he's saying that the breakouts are there. Very rounding bottom oriented type of approach as well. And the 60-40 took a long time. Michael's approach, from my point of view, is momentum oriented. And so while Jordan's has said, okay, we've broken out, Michael's seems to be saying that the acceleration is nigh.
In today's market rundown, a clear message is emerging. Precious metals are stepping into a new phase of long-term strength, while traditional assets begin to lose momentum. With yields flat, equities under pressure, and volatility climbing, gold and silver continue to show resilience, an early signal of shifting capital flows. Analysts highlight that gold's breakout against major benchmark portfolios, including the traditional 60-40 model, marks a structural turning point investors have been waiting for. Silver's setup appears even more powerful. As momentum patterns tighten and long-term ceilings weaken, analysts suggest the metal is preparing for a larger acceleration once key thresholds clear. This aligns with broader trend confirmations across miners, metals indexes, and momentum-based models that indicate a slow, grinding bottom has transformed into the early stages of a sustained move higher. Taken together, these signals point to a generational rotation toward precious metals, one driven by weakened equity leadership, rising volatility, and global uncertainty. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.